Hello, everyone. Thank you for joining us today for our Focal Point webinar. My name is Bud Davis. I'll be your co-host today with our presenter, Eric Hallinan. I'm an associate out of our California office in Dana Point. So our topic today is going to be how independent insurance firms can become regional or national brokers. As we're going through the presentation, we encourage you to include any questions you may have in our chat. And at the very end, during our Q&A portion, we'll try to address as many questions as we can. So a little bit of background on MarshBerry. We're a consulting and advisory firm focused on the insurance and wealth management industries. We're headquartered in Ohio, and we have 5 additional U.S. offices, and we have a growing international presence as well. So our goal at MarshBerry is to help firms to learn, improve, and realize their value. We offer a full spectrum of solutions for value creation, where we can meet firms anywhere they're at in their life cycle. So for Learn, we have proprietary data and analytics that our team spends a lot of time collecting and evaluating, where we can help firms to learn more about their firm and their performance and benchmark them with other like firms. For Grow, we offer various consulting services. We have our executive peer exchange network called Connect, and we do different consulting engagements such as strategic planning. And then finally, we help firms realize their value through our investment banking services, where we provide M&A advisory, and we do debt and equity capital raises as well. So our responsibility as a firm is to aggressively and intentionally confront our clients to make them uncomfortable so they embrace meaningful and often painful change in order to remain in control of their future. So that sounds a bit forward, but it aligns well with our topic today. That growth, the kind of growth required to become a regional or national broker, can be very difficult. This requires tough decisions, meaningful changes, and it likely requires a lifestyle change for the organization. But that last part of the sentence is key. This mindset and responsibility we feel as an organization, it allows your firm to remain in control of your future, whatever that looks like. Today, our presenter is Eric Hallinan. He's a managing director at MarshBerry. He's been with us over 14 years now. He's with me in the California office. Eric's highly regarded for his experience and his expertise in several areas such as strategic planning, insurance firm valuations, as well as M&A advisory. So I'd like to welcome Eric to take it over from here.
Thank you, Bud. Really appreciate that. And thank you, everyone, for taking a few minutes out of your day to maybe learn a few things, focus on your business rather than in the whirlwind of your business. Today's agenda really is kind of set up nicely from what Bud was talking about. We are talking about what does it mean to set up a national or a regional brokerage from wherever you stand today. And you can see I have a real basic agenda kind of set up for us. Which path are we going to take? There are many paths that a firm could choose to follow. And one path is this broker formation path. So we kind of need to set the stage for how that differs from some of the other options. Why form a national or regional broker? What are the benefits of such a path? And get to the point where we talk about some key takeaways, and we will certainly field a number of your questions. So the question starts with, where are you headed? And I want to set the stage with something in the fact that we're all here in the insurance brokerage space, and we believe that this is the greatest industry in the history of mankind. So much so that when you really grab the reins and take control of your organization and the path that you're on, you can do really, really amazing things. There are plenty of very strong, good, above average performers in the insurance space this is such a great industry. You've got recurring revenue. You've got no major inventory or machines or anything like that that you have to work on. It's a purely cash flow business. It's a sales business where you sell something that everybody has to buy. And if you screw it up, there's a robust secondary market just waiting in line to potentially purchase it from you and take that off your hands. It's a great industry. And what I want to challenge everybody with today is to not settle for average, to actually push the envelope, to take control and be one of those top performers, because that's what it means to become a national or a regional broker. You have to have a growth mindset, not a fixed mindset. The focus needs to be on sales and on producers and on achieving that outsized growth potential. You'll hear MarshBerry talk about what growth rate should we have? What sales velocity should we have? And then we'll say, a good number is 15% net growth per year. And people, their eyes get wide and go, wow, that's a big number. Well, it kind of is, but there are plenty of firms that are actually doing better than 15% growth per year. And when you do that, when you grow 15% per year, you stay in control of your future. And it allows you to understand what that path might look like when you can control that growth number, when you can line up your budget and your projection towards that 15%. What really becomes in your sights is that $1 billion valuation in 20 years. And that's something I want to highlight. The fact that you should think about plan for a number, plan ahead, and put that vision in place, because you're going to need more than just you and what goals you have in your mind to drive this thing towards that regional broker status. And I really like this quote from Steve Jobs. We're here to put a dent in the universe. Otherwise, why else be here? And this is an industry, I think I may have said this before, it's really, really easy to be average. It's really, really easy to just sit back and get the renewal income that you get every year and not push the envelope. And you know what? If that's the choice that you want to make, that's fine. You can have the greatest lifestyle. You can send your kids to college. You can have a great house. It's all of that is true. But if you have big, lofty goals to become one of those national or regional brokerages, the path is there, and that's what we're going to talk about. And you can put that dent in your own personal universe. And here's just a way to see how the numbers actually play out. If you grow 15% per year, and let's just say, for example, you're 20 million in revenue right now, 20 million in 5 years would be 40 million. 5 years after that would be 80 million. Another 5 years, 160 million. And another 5 years, 320 million. It sounds crazy, but every 5 years you would double in size if you simply grow 15% per year. And at 320 million in revenue, you would easily be $1 billion in valuation, certainly in today's valuation metrics. So right, it does get harder. You need more people. You need more smart people. And I'm not going to be able to give you the path and all of the building blocks for what it means to be in year 15 of this 20-year cycle. But the concept of setting it down today and reverse engineering it back to now is possible. And part of it starts with having a vision of sharing ownership and doing this with more people. Do you want to have 100% of a grape or 25% of a watermelon or even 10% of a watermelon? When the pie gets bigger, when the item gets bigger, everybody wins, even you, if you're trading between 10% of a watermelon or 100% of a grape. And so let's talk about some of the different paths really quick. There's probably more paths than this, but we often talk about things in terms of the 6 paths. Selling to a strategic buyer or doing internal perpetuation for the long-term succession of an organization used to be essentially the only options. And then a few firms became ESOPs. We still have plenty of ESOPs out there, and those are the employee-owned organizations. As you started to see a path of firms taking on an equity partner, whether it's a minority or a majority, and starting to kind of grow and utilize that equity capital to invest either in acquisitions or in new employees, like new salespeople. You can also raise debt capital to fund some of those investments. And then the last option here is broker formation, which we're going to spend more time on. One thing that's not shown on this list is really this last option, which is grow at 15% organically and annually. And that really is one of the paths you could take to essentially become a regional or a national broker. It's the long-term strategy. It's the sort of get rich slow strategy. That's not the path that I'm going to talk about today. What I'm going to talk about is, what if you put a strategy in place right now that allowed you to become a broker right now, one of these big regional brokers? And there are firms that have done it. I've got the examples here: Alara, Patriot, and Oakbridge, which I'm going to spend a minute talking about. But let's dive a little bit deeper into this topic. We have some case studies. So back in 2016, the Alara Group formed, and it was 24 firms that sold all at one time. They basically took on capital from Genstar, which is a private equity firm. And those 24 firms came together on one day and became a regional, or essentially a national broker overnight. They had offices in 15 states, and they were scattered all across the country. So they had a national presence at that time. Prior to this, no one had really done this. There have been a couple of groupings that came together, and maybe they did something. And I'm not going to say that, there was definitely zero precedent for it. But the fact that Alara did this, and there were 24 separate firms, they happened to know each other through a few different networks. And that was where those relationships started. And I'm going to spend some time talking about that part of the strategy. And that seems to be something that is relatively common when you look at some of these case studies. Patriot Growth Insurance Services is another one that followed a very similar path. This one was formed on January 1st of 2019. It was 18 firms that came together, and they took on capital from Summit Partners, and they became a national broker. They had a presence all across the country. They happened to be in 7 states, but those 7 states were scattered throughout. And both these firms, Alara and Patriot, have since to go on to continue to do acquisitions and continue to grow both organically and by acquisition. The Patriot organization also came together through relationships that they had through a couple of different networks. So these firms that were part of the original Patriot formation were members of a network, so they had a chance to get to know each other and get to build relationship and kind of socialize the idea of coming together to form a company. And that's exactly what they did. That's what Alara did as well. Oakbridge is the third United States-based organization that MarshBerry has helped put together, kind of forming a national broker overnight. There were 4 firms that came together. They were regionally focused in Georgia and have since to do acquisitions kind of throughout. But that was their focus and what they had intended to do. They had utilized a financial backer in Corsair Capital and kind of followed a very similar type of concept, albeit starting with just 4 firms. And all 3 of these examples are valid as, on day one, you now become a top 100 broker, and you go forward utilizing the capital of your investor to continue to either invest in producers and books of business, as well as acquisitions. Lastly, of our case studies is the Licent Group, which is essentially a restructuring, or that's what they call it. This actually finalized in March of 2024 of this year. 16 firms sold and came together into one holding company, and this actually took place in the Netherlands. So this is a European broker formation, and they became one of the top 25 brokers in the Netherlands, which is a major feat, just like the others. And so what kind of similarities, what kind of lessons can we glean from these 4 case studies of what it means to come together and take on capital? So the first is kind of the why question, because in comparison to other options that you have, Let's say you're like, well, I want the benefits of being in a large organization. Why don't I just sell to one of the large organizations and be part of them? I'm not interested in selling out and walking away, but I do want to be a part of something bigger and have more resources, etc. Well, what if you could do that and kind of obtain that status and those resources, but you get to design it along the way? That's one of the key pieces here. You get to look at all of these things and essentially be in control of all of them. Operational autonomy. You get to retain your brand or have a strategy around branding beyond even your own initial setup based on the acquisitions that you might do and where you do them. Are you going to have vertical specialization? What industries will you serve? Is it going to be a generalist? Are you going to focus on a number of different regions or a number of different industries that in the insurance space? What are you going to do with the capital? You get the choice of what you might do with the capital, how you come together and collaborate with the partners, et cetera. I'm not necessarily going to read out all of these. The point is you get to design the culture. You don't just tag along or join up with somebody else's culture. And beyond that, you get to collaborate on how a lot of these things will come together. If you join a large group organization today, you're going to follow their prescribed path for a number of things. Now, there's going to be some autonomy that they provide, but there are going to be a number of things that are just going to be prescribed. If you form a national broker by bringing some firms together, you get to, for example, how are you going to handle all the operational exchanges as you look on the far right item here? HR, IT, finance, other resources. How are you going to deploy those resources? Maybe that stuff isn't even defined yet, and you want to have the opportunity to organically develop that with a group of partners. That's the path that you can put forth and take the time to design the strategy for yourself. If you think that all of the other large organizations are missing the boat on some really good idea in terms of workflow or really good idea in terms of technology integration, you can just say, never mind that option. I'm going to do this myself with a group of like-minded people. And let's talk about what the scale actually provides. Scale itself becomes a resource that allows you to do more. And if you look back in the year 2000, there were only 2 firms that were over $1 billion in revenue. In 2010, there were 6 firms that were over $1 billion in revenue. And in 2020, 13. So and the average top 75 broker, where that top 75 was, you can see how that has just gone up dramatically from 246 million all the way up to 960 million in 2020. And the market share of these large brokers is expanding. So you can't tell me that there isn't power and scale and resource and scale. What the big get bigger, the big get stronger, the big are able to outcompete those that are smaller. And so why not figure out how to become big? And over time, the belief is there's going to be fewer brokers and larger brokers, and having carrier clout, carrier negotiation is going to become an issue. Technology becomes expensive, especially at the higher levels, and so that scale provides more of a competitive edge. So big important factor just in terms of scale. What are some other benefits? This is going to get into a little bit of the financial engineering, a little bit of the esoteric knowledge behind the scenes. And I think this is why go this route versus trying to do it by yourself. Because yes, you can keep hiring, you can keep doing opportunistic acquisitions, you can potentially take on some debt capital and go in this direction to form a broker over time. But what if you could do it overnight? And what is the financial engineering of that? That's what I'm going to talk about next. So in the case studies and in the concepts we're talking about, you would have a direct investment from a private equity firm. And what is the thesis of a private equity firm? Well, they have certain lines of business that they're interested in acquiring. So while there's probably hundreds and thousands of private equity firms, there are a subset of those firms that want to invest in financial services, and even a subset of those that want to invest in insurance and wealth management. So that's a piece of this, is the audience is a little bit narrowed based on that focus. They have embedded growth opportunities, meaning that there are sister companies or sibling companies that those private equity firms are going to invest in, and they can have symbiotic relationships with each other. So you can help, do the insurance work for some of their sibling companies underneath the same PE relationship. And all of these firms have a targeted financial return. So they're not just gambling with the money, saying, here, I'm going to drop, X millions of dollars and just wait for it to generate a return. They actually have a thesis. And that thesis typically is, we want 3 turns of multiple of invested capital, or MOIC. I want 3 turns in 5 years. And what that means is, once they can adequately do the analysis and see that they believe their return is at that 3x, they will look for a new sponsor and look to exit their investment. Because what they're doing is, they're financial stewards of the funds that they create. And the funds that they create are typically very large and made up of institutional capital that needs to be preserved and carefully managed. Think like pension funds and stuff like that, where we can't gamble with this money. So we need to be careful. We need to be careful financial stewards. And so they're going to be measuring those expected returns, and they're going to be careful about exiting when the time is right. And they're not just going to sit there and say, let it ride, let it ride. There are other investors that do this sort of thing and might have a longer term strategy, or maybe more of a higher risk tolerance, but the typical private equity firm follows a very disciplined format, and they are temporary by nature. I'm going to talk a little bit about some of the obvious benefits of the formation. You get a seat at the table. Constructing, I've already spent a little bit of time talking about that. You get to crystallize value at a time when valuations are high. If you've seen any MarshBerry presentations or read any of our articles, you can see that valuations are high, and they have been high for several years. Will they stay high? We don't have a crystal ball. I don't know what's going to happen 5 years from now. And you might say, this is a good time to crystallize that valuation and take a few chips off the table, but still be in the driver's seat, driving the organization forward. And even though interest rates have gone up in recent years, they are still historically at low levels. So access to credit is still relatively inexpensive, and it is relatively easy to obtain that credit when you're larger and you have more profitability built into the business, which you would have as a larger broker. And if you were coming together with several firms, that multiple that you would enjoy in terms of the valuation multiple would be higher than you would get on your own. All things being equal, valuation is highly dependent upon the size of the organization that's getting valued. A smaller firm is going to have a lower multiple than a larger firm, all things being equal. But here's the magic. The magic is, you get tax deferral on the rolled equity, so you don't actually have to pay taxes, capital gains taxes, on the entire price day one. You roll that equity portion. If you roll 25% and you utilize a portion of debt to fund the transaction, that 25% can actually become 40% in the given asset once it's formed. And I'm going to show you how that works in just a moment. But that's a little bit of the magic of the financial engineering. And you can grow that 40% equity to more over time as you continue to do acquisitions. So if you desire, as the initial founders, you can grow and maintain your future and actually increase your holdings of the total and get back into a control ownership position if that's something you desire. And then that rolled equity could produce a 3x turn multiple in 5 years. And if you have a long runway, that 5 years can become 10 years, can become 15, 20 years, and you can roll it each time. And that 5 years is not something that's set in stone. It might be 3 years, it might be 6 years, but the goal is 5, and the modeling is built around 5. Couple of things, the magic of the leverage first. When you include the leverage, let's just use this example. If the value is 14x and we have half of it funded by debt, that means the equity portion is 7x of the value. If we get 12%, 12.5% return on value, knowing that 50% of the enterprise is equity and 50% of the enterprise is debt, just doing the math on that means that the return on invested equity is actually 25%. Using the debt actually juices the returns by double in this particular example. So that's part of it. Part of the magic is the power of leverage. Another part of the magic is the growth. Because you're using capital to grow, and where that growth might come from is either in acquisitions or hiring producers or purchasing small books of business, you can manage that 3x return faster. So if you're growing at 25%, which is possible when you're using capital to do it, you can actually see how that math works to get in 5 years, three times your return. And then this last little bit of magic, how does that 25% become 40%? In this case, let's just look at this example. If we had a total proceeds example at 12x, cash was 75% of it, and equity was 25% of it. You can see that math here. If we utilize 4.5 times EBITDA to fund part of that transaction using debt, that means the equity, the seller and PE equity, is only 7.5x. And that, if 3x, you can see 3x here, of that 7.5x, that equals 40%. And so ultimately, of the equity portion that remains, the original founders could magically turn that 25% into 40% and now write a 40% return on equity going forward. And while this is a very simple example, you can see if you were just to grow 15% per year and you kind of did it on your own and you're a $15 million broker, you can see how this flows. And over time, yes, it's a great return. You get to, in 10 years, 120 million. But if you come together with some firms and really juice the potential, this is what the valuation might look like if you were a consolidated broker. And now you're looking at 1.3 billion in potential value over a 10-year period. So this is just a simple example to kind of show you the magic of how much this can, the value of the compounding and the value of starting at a higher number. So beyond value, just to kind of highlight some of the things we talked about, you get to maintain significant operating autonomy and individual identity. You get greater scale to enhance long-term ability to raise additional capital and remain viable. That size is a real magic key to this. You gain resources clearly, either due to your size and your ability to acquire those things, or as you continue to do acquisitions, those acquisitions can bring on those resources as well. You could establish the culture. You gain operating efficiencies by sharing back office resources, and you continue to increase that scale. Profitability actually continues to grow up both in real dollars as well as in margin. And you create a real sense of accountability for everybody that comes together to form this organization. And greater volume, increased carrier remuneration just in your premium dollars, and you also provide an opportunity for the next generation to obtain equity. This can be something that creates legacy and drives forward for future generations. So one of the major things that's a building block here is you have to, if you like this idea, you got to find some friends. Who might you partner up with? What networks are you a part of? What trade associations can you join up with and build relationships with to potentially socialize this idea of coming together? It takes a little bit of vulnerability. It takes a little bit of courage just to kind of hold that branch out there and see who would be interested in joining up and forming a multi-company combination. That's part of the secret, is getting that initial group together. And if you still like the idea, but maybe don't want to go the route of getting a bunch of friends together to come together at once, The path of aggressive growth and individual acquisition opportunities does exist. It just takes longer. Maintain a seat at the table, utilize the power of leverage and scale. And we invite you to continue the conversation with us. This is a broad topic. There are a lot of different ways to look at this. And I really just kind of gave you the tip of the iceberg today. So with that, I'd like to see if there are any questions or otherwise how we might continue this conversation.
Great. Thanks, Eric. Here's a question. So how should agencies think about the firms they should partner with? Should they be aligned in size, location, line of business?
Yeah, I think that's a really good question. And there are a couple of different ways to think about it. There's no right answer, but I think the most important thing is just determining who you like to work with. Where do you have cultural alignment? From there, other strategies will spin off of that, whether it's cultural alignment and regional alignment, kind of like the way Oakbridge started in Georgia. Or maybe you have a line of business alignment, the way that the Patriot organization formed, where the majority of those firms on day one had a high concentration of employee benefits revenue. They've gone on to do acquisitions that include a lot of P&C, and they've had a lot of P&C growth. But that's how they started, was mostly in the benefits space. So some of it just starts with the nature of the relationship you start with, and aligning on culture and personality and ability to work well together. That has to be the ingredient number one.
Great. Are there any examples of these types of projects not making it to the finish line, and any lessons that were learned?
That's actually an excellent question, because it's pretty easy to sit in a room like this, and we've even done this. We've sat in a room of mixed company, shared a presentation about what it means to potentially come together, share the examples of Alera and of Patriot, and it sounds like a great idea, but it's a lot of work. It's a lot of vulnerability. It's a lot of setting aside ego, sacrificing a little bit for the common good and bringing it together. And that's easier said than done. And we have seen firms that have very great intentions of trying to come together, whether it's a small cluster and they realize they could do better if they maybe came together as a single organization, or maybe it's a group of firms that happen to know each other over time. They've gone to like big I association events and they've become friends, and they start to socialize this idea, and they hit a number of roadblocks. Some of them might be, who's going to be the leader of the organization on day one? Or, will you argue about how much capital you might need to take on? And all of these things just create roadblocks that could potentially cause it to stall out. And we have seen some of these opportunities go from the grand idea of becoming a national broker and converting into, rather than us trying to solve all of the problems and design everything, why don't we just come together and uniformly go in one strategic direction, and we'll join up with one of the larger firms, one of the larger brokers that already exists. And we have seen a few go in that direction as well. It's one of those things that's multifaceted, a little bit complicated, and just being open-minded to the fact that you're going to hit roadblocks. Some of those roadblocks are solvable, and sometimes they're not.
You had mentioned earlier there's hundreds of private equity firms out there. How would an agency go about vetting which private equity firm they should partner with? Like, how do they know they're going to be a good fit?
What I would recommend is taking on an advisor through that process. Utilize an investment bank. MarshBerry we're equipped to do that, but my answer here is a little bit more selfless. I don't think you could go about and do this on your own. I think you need representation, someone who can help you navigate those relationships. Because like I was mentioning before about finding those firms to come together with, and why it matters to have good personality connection, good cultural connection, ability to work well together, that applies to the private equity firm as well. Not all private equity firms are created equal. They all have different personalities, different goals, different ways that they like to work. and you need to make sure that you find a good fit. And managing fit is going to be key to managing value and long-term value creation. So that's why we would recommend utilizing an advisor to help you navigate that process, help you vet many firms to navigate towards the right fit.
Well, I think that was all the questions we had.
Well, I appreciate everybody's time and attention. Thank you so much. Please feel free to reach out to any of us if you have any questions about this or anything else that we might be able to help with. And have a great rest of your day.